Welcome back to the channel, Rail Transport Enthusiasts. In today's video, we'll dive deep into four major players in the railroad industry: Canadian National Railway Company, Canadian Pacific Kansas City Limited, CSX Corporation, and Union Pacific Corporation. Each of these companies plays a crucial role in North America's transportation network, and their financial metrics offer us valuable insights into their growth potential, profitability, and overall market performance. So, without further ado, let's jump right into the numbers and see how these companies stack up. One of the most basic and widely used metrics in investing is the price-to-earnings ratio, which tells us how much investors are willing to pay for each dollar of earnings. Currently, Union Pacific tops the list with a P/E ratio of 23.39, suggesting the market has high expectations for its future earnings. Canadian Pacific Kansas City comes in next with a P/E of 21.16. Followed by CSX Corporation at 18.42 and Canadian National Railway at 16.34. These numbers indicate that Union Pacific is perceived as a premium player in the sector, while Canadian National Railway appears to be more conservatively valued. When we look at the 5-year average P/E, we see that Canadian Pacific Kansas City has typically been valued higher with an average P/E of 25, followed by Canadian National Railway at 23.26, Union Pacific at 22.03, and CSX at 19.56. This shows that Canadian Pacific has traditionally commanded a premium, possibly due to investor confidence in its growth potential and strategic operations. Looking at the forward P/E ratio, which gives us insight into expected future earnings, Canadian Pacific and Union Pacific continue to command higher ratios at 23.11 and 19.92, respectively. Canadian National Railway sits at 18.81. and CSX at 15.62, suggesting that CSX might be a bargain if it can meet or exceed earnings expectations. A more nuanced metric that accounts for growth expectations is the price-to-earnings to growth ratio. Here, Canadian shines with a P/G of 1.62, indicating that its growth is attractively priced relative to its earnings. CSX follows closely with a P/G of 1.81, while UNP has a P/G of 1.92, and Canadian National Railway comes in at 2.40, signaling that Canadian National Railway's stock might be a bit overvalued compared to its growth prospects. Next up, let's talk about insider ownership, which is a great indicator of how much skin company executives have in the game. Canadian National Railway leads the pack here with 3.19% insider ownership, which is quite significant. Union Pacific and CSX follow with 0.27% and 0.15%. respectively, while Canadian Pacific lags far behind with just 0.02% insider ownership. This stark contrast suggests that Canadian National Railway's executives might be more personally invested in the long-term success of the company, which could be a positive signal for potential investors. When it comes to return on equity, Union Pacific dominates with an impressive 43.76%, signaling that it's highly efficient at generating profits from shareholders' equity. CSX is not far behind with 28.84%, followed by Canadian National Railway with 27.18%. Canadian Pacific, however, lags with a return of equity of just 8.24%, which might raise concerns about its efficiency compared to its peers. Looking at return on assets, Canadian National Railway leads with 10.33%, demonstrating strong asset utilization. Union Pacific comes in second at 9.7%. followed by CSX at 8.59%, while Canadian Pacific posts a lower 4.27%. When we shift to return on invested capital, Union Pacific again comes out on top with 15.47%, indicating that it's generating solid returns on the capital it has invested. CSX and Canadian National Railway are neck and neck with returns of invested capital of 14.29% and 14.26%, respectively, while Canadian Pacific trails with 7.18%. Another important metric to consider is the evolution of shares outstanding, which can have a major impact on shareholder value. Canadian National Railway has been decreasing its share count at a -2.68% compound annual growth rate, which is a positive signal as it shows the company is committed to buybacks, boosting the value of each share. CSX and UNP have also been reducing their share counts with a -4.60% compound annual growth rate and -4.24% compound annual growth rate, respectively. Canadian Pacific, on the other hand, had been buying back shares until 2021, but since then, its share count has remained flat after a huge increase in 2022 due to new investments, signaling a change in capital allocation strategy. In terms of earnings per share or EPS, Union Pacific stands out with an EPS of $10.65, significantly higher than its peers. Canadian National Railway comes in second with $7.27, followed by Canadian Pacific with $4.08, and CSX at $1.82. However, it's not just about the current EPS. We also need to look at expected growth over the next 5 years. Canadian Pacific leads the way here with a projected EPS growth rate of 13.04% compound annual growth rate, followed by Union Pacific with 12.2% compound annual growth rate, CSX with 10.15% compound annual growth rate, and Canadian National Railway with a more modest 6.81% compound annual growth rate. Historically, all 4 companies have shown strong EPS growth. CSX leads with a 12.31% CAGR over the last decade, reflecting its consistent earnings expansion. CP follows with a 10.22% CAGR, while CNI and UNP posted EPS growth rates of 7.6% and 7.09% compound annual growth rates, respectively. When it comes to free cash flow per share, CSX again stands out with a 19.4% compound annual growth rate over the last decade, making it a cash-generating machine. Canadian Pacific and Canadian National Railway have also shown solid free cash flow growth with 10.9% and 9.07% compound annual growth rate, respectively, while Union Pacific comes in at 9.96% compound annual growth rate. For dividend-focused investors, Union Pacific offers the highest yield at 2.15% with quarterly payments of $1.34 and a 10.76% compound annual growth rate in dividend growth over the last decade. However, its free cash flow payout ratio is a little bit higher with a value around 70%. Canadian National Railway follows with a yield of 2.09% and a 10.42% compound annual growth rate in dividend growth. This company's future dividend growth is also in trouble due to over 60% free cash flow payout ratio. CSX provides a yield of 1.55% with quarterly payments of 13 cents and an 8.45% compound annual growth rate. So we have less initial yield and also less historic growth. However, in this case the free cash flow payout ratio remains healthy with a value below 40%. Finally, Canadian Pacific offers the lowest dividend yield at 0.65%, but it still boasts a respectable 8.4% compound annual growth rate and a free cash flow payout ratio below 40%. To sum up, the companies that have higher initial yield are the ones that also have more dividend growth. But this last decade's impressive growth leads to a higher free cash flow payout ratio, which means that over the next decade, its dividend is unlikely to grow at the same rate as it has so far. When it comes to efficiency and profitability, Union Pacific leads with an operating margin of 38.64% and a profit margin of 26.9%, demonstrating its strong operational efficiency. Canadian National Railway follows closely with an operating margin of 38.25% and a profit margin of 32%, reflecting its ability to convert revenue into profits. CSX and Canadian Pacific also show solid operating margins at 36.76% and 35.74%, respectively, although their profit margins are slightly lower at 24.52% and 24.45%. In terms of the evolution of revenue and earnings, Canadian Pacific has seen the most positive evolution, which has been reflected in its market price, achieving a return similar to the S&P 500 ETF, VO, over the last 5 years. Canadian National Railway and CSX have also seen positive revenue and earnings growth, but their stock performance has lagged behind the broader market. Finally, Union Pacific, on the other hand, has shown flat revenue and earnings growth, and this has been reflected in its market price, which has underperformed the VO although outperformed the other 2 companies. Finally, let's talk about debt levels, which can significantly impact a company's financial health. Canadian National Railway has a debt/EBITDA ratio of 2.12, indicating a manageable level of debt. CSX and Union Pacific follow with both ratios below 3 with values of 2.64 and 2.82, respectively. While Canadian Pacific has the highest debt/EBITDA at 3.16, which might raise concerns about its leverage. When we look at debt/free cash flow, all four companies have too high ratios, but this is because they are companies that need a huge amount of capex to continue their operations. In terms of market capitalization, Union Pacific is the largest with a market cap of $151.76 billion, followed by Canadian Pacific at $80.58 billion, Canadian National Railway at $74.80 billion, and CSX at $65.00 billion. All four companies have delivered positive price returns over the last 52 weeks, with Union Pacific again leading the way with a 17.44% return, followed by Canadian Pacific at 10.67%, CSX at 9.9%, and the lowest one Canadian National Railway at 6.77%. Now, let's talk about the crystal ball moment: analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. Canadian National Railway has a price target of $173.86, representing an upside of 46.38% from its current price of $118.77. My fair value estimates tell a very different story. For me, Canadian National Railway is close to its fair value at $118.70, suggesting it is fair valued. Continuing with Canadian Pacific's price target is $125, which actually represents an upside of 44.81% from its current price of $86.32, indicating that analysts see the stock as potentially undervalued. And for me, Canadian Pacific, with a fair value of $82.04, appears currently slightly overvalued. Now, CSX Corporation has a price target of $38.78, with an upside of 15.69% from the current $33.52. And for me, with a fair value of $33.22, can indicate a reasonable price. Finally, Union Pacific's price target is $260.44, representing a modest upside of 4.54% from its current $249.12, with a fair value for me of $231.58, which is not close to the current price and can indicate an overvaluation. These valuations indicate that while there is some potential for growth, investors should tread carefully and consider these stocks' current pricing relative to their intrinsic values. So, there you have it. Each of these railroad giants has its own strengths and weaknesses. Union Pacific stands out for its high profitability and operational efficiency, while Canadian Pacific boasts strong growth potential and being the only company that operates in all three countries of North America. CSX is a cash flow machine, and Canadian National offers a solid blend of profitability and shareholder returns. Your investment choice will depend on your financial goals and risk tolerance. Let us know in the comments below which of these companies you think has the best long-term potential. If you found this breakdown insightful, don't forget to hit that like button, subscribe, and ring the bell for more in-depth financial analysis. Until next time, happy investing!